Hello there, we are Team A. We are Ascend Footwear. I am Philip Spencer.
I am Kenneth Blake Hancock.
And I am Delilah Vega, and I'm one of the co-managers for Ascent Footwear. Throughout the simulation, our team has worked together to build a strong foundation and lead in the premium athletic footwear market. I'll be helping present our team's strategy, our performance, and the key decisions that contributed to our success. I'd also like to take a moment to mention Rosie Parr, one of our co-managers. She played a major role in developing our analysis and preparing the lesson learned section. Unfortunately, she couldn't be here due to a medical absence, so our team will be presenting her portion on her behalf. So let's go ahead and cover the table of contents. In this presentation, we will be covering our strategic vision, our key financial metrics, our competitive analysis, and our lessons learned. So moving on to strategic vision, let's talk a little bit about our company. So Ascend Footwear, we strive to become a leading name in the global athletic footwear industry through a broad diversification and a commitment to excellence. Our strategic vision is to deliver superior quality and performance-driven footwear and a premium standard, establishing Ascend as the brand of choice for athletes and active consumers alike. By investing in large-scale, efficient manufacturing operations, we aim to ensure a consistent supply, meet growing market demand, and sustain long-term competitiveness in the global market. So a little bit about our goals. We had some short-term and long-term goals. So our short-term goals were to focus on strengthening the foundation that we've built. This means continuing annual product upgrades, expanding celebrity and influencer partnerships, and improving customer service through faster delivery and free shipping. These actions help us stay innovative, visible, and profitable in the near term. Looking ahead, our long-term goals center on establishing Ascend Footwear as a global leader in the premium athletic market. We aim for sustained revenue and EPS growth through consistent innovation and brand expansion. Over time, we plan to evolve from just a footwear company into a broader lifestyle brand, maintaining strong shareholder confidence and long-term market dominance. So what sets us apart? What sets Ascend Footwear apart is our commitment to excellence on multiple fronts. We lead with quality and innovation. Each product is designed to outperform both in function and in style. Our brand power extends beyond the shoe itself. Through celebrity endorsements and brand connection, we have built a strong, lasting connection with consumers. We maintain a careful balance between bold growth and smart execution. This approach ensures that we remain financially sound, innovative, and trusted by both consumers and investors. So year 11, let's talk a little bit about our North America strategic group map. So Team A, our plan was consistently centered on broad diversification within the athletic footwear market. In year 11, the team intentionally adopted a slower pace, choosing to observe competitors' moves before making large-scale investments. This cautious approach allowed for valuable market insights and reduced early risk exposure. So despite the deliberate pace, we did make early investments to establish a presence in the different diversification space, ensuring readiness for future expansion. As the market evolved, the team transitioned from a measured strategy to an accelerated one, aimed at moving rapidly toward the top right corner of the market map, representing a broader product line and superior price quality positioning. This evolution demonstrates a balance between strategic patience and decisive execution, enabling Team A to capitalize on timing and scale opportunity effectively. So moving forward to year 17, Team A consistently pursued a broad diversification strategy in the North American market. Over time, we strengthened our price and quality performance, which allowed us to move steadily toward the top right corner of the market by year 17. Between years 14 and 16, we noticed that Team E had adopted a similar approach, so we carefully monitored their decisions to adjust our own strategy. Our early expansion and willingness to take on debt gave us the flexibility to scale production and improve product offering, which in turn, we offered products faster than our competitors. This deliberate balance of growth, financial risk, and market awareness ultimately positioned Team A as the industry champion, proving the long-term strength of our broad differentiation strategy. So now I'll pass it on to Blake, who will be covering our key financial metrics.
Thanks, Delilah. So first off, we will discuss our top line net revenues for Ascend Footwear. As you can see, from year 10 to year 17, our top line revenue quadrupled over that 7-year period. As we know in the shoe industry, revenue is really a function of shoes sold and the price it's sold at, which led us to our strategy of the broad differentiation, where we would push price and offer high number of shoes. Early on, we invested heavily in manufacturing capacity in all 4 regions, allowing us to have optional versatility as we progress through the game. We also made an early decision that we were going to push our SQ rating, ending at 10 stars, and our shoe styles to 500, the maximum we are able to do. This focus on premium quality and innovation allowed us to push prices higher. Our strong reputation with marketing and celebrity endorsements also allowed us to attract customers seeking superior products. As we progressed over the course of the years and equipment in North America and Asia became obsolete, our strong revenues and our investment early in manufacturing allowed us to continue to hold our produced number of shoes flat, if not growing in year 17, allowing us ultimately to meet not only the branded demand that the industry gave us, but also allowed us to have ample supply to attack the private label market aggressively, which added not only incremental revenue over the last several years, but also allowed us to also improve margins, which we will talk more about as we get to EPS. Our continued product differentiation limited direct price competition outside of competitor E, and ultimately allowed us to achieve the revenue targets that we reached in year 17. Overall, sustained revenue growth was indicative that our customers were willing to pay more for quality and brand distinction, validating our strategic focus on high price, high quality differentiation. If we move on to looking at earnings per share, the epitome of the bottom line of the P&L, our EPS grew from $2 a share to $22.79 a share. We know EPS takes into account everything that the company endures, right? From fixed costs, SG&A, interest expense, and taxes. Obviously, growing revenues meaningfully helped our EPS over the years. But our investment in manufacturing in each region also allowed us to not only meet demand at a regional level, but it also helped us minimize tariffs and import costs from moving shoes around different parts of the region. Also our early success allowed us to have an improved balance sheet, which allowed us to lower our interest expense by refinancing debt early and lowering our interest expense towards the back end, giving us even further optionality with our EPS. As we progressed to years 15 through 17, our use for cash flow became limited as we had maxed out what we believed was our manufacturing footprint to take the optimal amount of shares, and ultimately allowed us to reinvest our free cash flow into stock buybacks. Our stock buybacks allowed us to meaningfully improve EPS over the last 3 years, ultimately allowing us to get our return on equity north of 40% at year 17, as we had hundreds of millions of free cash flow at that time. The upward EPS trend reflects how our premium pricing, manufacturing footprint, product excellence, and marketing differentiation work together to boost profitability and strengthen our competitive position. Lastly, we'll talk stock price, going from $30 a share to $532 per share. Stock price is really a function of EPS growth and investor confidence. Every year we exceeded our investor expectations when it came to EPS, ROE, and our credit rating. Our stock price was largely a function again of our EPS growth that we witnessed over the 7-year period, which also led to the higher ROE of over 40% when we got to year 17. At the end of the day, the increase in stock value demonstrated that our revenue gains, margin expansion, and EPS growth translated directly into shareholder confidence and market value. And with that, I will turn over to Philip to talk about our competitive analysis.
Thank you, Blake. For the competitive analysis, we focused on our closest competitor, which was Team E. Team E pursued a broad differentiation strategy similar to ours, focusing on high-end quality products, strong brand positioning, and premium pricing. The market position, based on the chart, in both North America and Europe, Africa, Team E's products cluster in the high-end, high-price range, similar to ours. Their product breadth was also wide, showing focus on offering multiple premium models across segments in both internet and wholesale segments. They maintained strong SQ, style quality ratings, and consistent brand visibility. Team E overall was an effective rival and even outperformed us twice over the 7-year period, mainly during years when they timed product updates and marketing campaigns aggressively. Their pricing strategy balanced profitability with market share retention, allowing them to temporarily edge us out in customer preference and financial performance. However, their cost structure and limited flexibility may have prevented sustained dominance, as our continuous investment in innovation and celebrity endorsements helped us regain leadership later. For the competitor analysis over the next 2 to 3 years, the goal was to strengthen our leadership in the premium market through innovation, brand power, and customer experience, outperforming Team E's similar broad differentiation approach. The core approach was broad differentiation but enhanced. We aim to accelerate innovation by launching new or upgraded models annually to stay ahead in style, quality, and tech. Boost brand power to expand celebrity and influencer endorsements for strong emotional branding and online visibility. As we attempted and successfully outcompeted Company E, we chose to focus on 4 things: scale, quality, capital structure, and private label. We realized early that the most effective way to compete with Company E was to make sure that we took advantage of the economy of scale. The more shoes that we manufactured, the cheaper it was to manufacture the shoes. And that really ended up being one of the deciding factors in the end, because in the very last year, we had the highest production capability of any team, and we capitalized that by not only dominating the market share in the branded label, but also wholesale market, as well as private label. We dove into all 4 private label segments, dominating market share by year 17, with capturing over 30% in each market, which was far above any other team in the game. Our quality was unmatched. We ended with the highest quality rating available, and our capital structure allowed us the flexibility to take advantage of not only the economy of scale, but the growing opportunities in private label. Lessons learned. For lessons learned, we learned that timing and confidence are crucial in strategic decision making. Investing early allowed us to build capacity, improve quality, and strengthen our brand foundation for the long term. We also realized the importance of conviction. Had we moved more decisively earlier, we might have captured a greater share of the market even sooner. Lastly, we saw how early leverage, when used wisely, can accelerate growth and profitability without creating financial strain. These lessons reinforced how calculated risk-taking and early investments drive long-term success. that concludes our presentation, and thank you for taking the time to listen to us.